What's up, everybody? Live FOMC coverage on the way. Fed raising rates? No. Cutting rates? Maybe. Happy FOMC day. All right, leading off today, this is what we got. We got Bull Zone IWM, Bull Zone QQQ, Bull Zone S&P. My drawing tool here. The way to read these liquidity maps. Breakout range is here or here. 60% chance we stay here. Risk interval 37 point something percent. Anything that falls 30 points, about roughly 560 on the event or 30 points higher, is the catalyst. So breakouts are here and here. Here's support. Breakdown is here. Okay. Write these levels down. 472.5, 475 on Q. 562.5, 563 on the S&P. Literally 5 points. 6 points. That's it. Tight range. Monthly hedge pressure expected to hold. Announcement comes out in 10 minutes. Rate cut, no rate cut. Any rate cut will be expected at best. Friends in the YouTube, don't forget to hit that like button. Problem's going to be S&P. Let's go ahead and take a look at this. Let's get ready for the future side of things. S&P DD bands written right there. Nasdaq here. Let's go ahead and do that calc really quick. I'm not in any position leading into this. Never, never, never do I go into it. 681. Risk interval from here to get the CD bands. Oh. 144 and a quarter. 19,825. Breadth of the range is about here. 536 is about here. $681. $536, or sorry, 681, 536. I'll just put it right there. It's right on the edge. And then 640. I usually trade after the event. So right now the event, I don't think it's going to do much but pop the market today and then probably sell off. Market's still bullish in general, but I think that the idea that I made that tweet on Twitter, kind of highlighting the idea that the highest probable chance that's been priced in is the most severe rate cut of the options. So I think in any particular sense, the market's going to be disappointed with what we get. But it's such a tight breakout range that anything breaking here is going to fall really hard. Anything breaking here is going to rally really hard. I'll guess that if we get a rate cut, it'll be moderate, 25. If we get 50, that's good. I think the market's going to try to move higher. Question is, how many people are going to want to sell? Based on this news. IV on options now rallying up to 90% at the money. So FOMC is expecting a big push in that expected range. Talked about that today as well. 100% IV. Guess you could just straddle. Not a terrible idea. With that being the likely option of what people will do, I really think that whatever happens, might do something like this for the day. There's a lot of pre-Fed selling, not because of not expecting a rate, but even expecting the idea that the rate cut would not be, would meet expectations, right? The market's not going to exceed expectations, so there's no reason for people to bet that it's going to come in better than expected. The VWAP, yep. I've got breakout puts, I've got breakout calls. I'm trading exactly that. Calls are shorter term, puts are longer term. I'm betting that the market is going to move higher. If there's a sudden surprise on the event that the market is displeased, i.e. expectations are not exceeded, Any pop will sell, and I've got some long dated puts just to hedge while I'm a bull in the market. Right now, my position is absolutely neutral at this point. Both of my positions are literally like sitting flat. This is right the launch point where I'm set up to go. Five minutes. Higher chance to also indicate economic. Higher basis point chance to indicate economic weakness. Well, in my tweet, I indicated that there's weakness in the job market. It's a slow growth. It's not booming like you'd want it to be. Now, it's not bad. It's just not growing fast. Just to review, if you guys want to do me a favor and check out this tweet I did, everyone in chat, I'll go have a look. Give the tweet some love. Oh. What is going on with my... I have no idea what's going on here. Tweet. Oh, here we go. Everybody do me a favor. Go read this really quick. We'll cover it. Go here. Click that like button. Give it some love. Give us a comment. Scenarios today. Pop and drop, the likely case. Pop and go, the rarer case, because the market's not going to be surprised if anything comes out today. Fed Watch is showing a high probability of 50 basis point cut, higher than a 25. S&P sitting at all-time highs, while CPI is coming down. Jolts are coming down, but unemployment is holding the fort. So it means that basically we're filling jobs faster than we're creating them. So it's just slow growth. Doesn't mean it's bad for the market. But what I think is that the press conference, if they don't hint at any kind of additional rate cuts in the future, like an aggressive set of policies to cut rates, so we're not going to rally big and keep rallying. The market is structured completely bullish going into this thing. The monthly maps, as you see, anytime you have the bull zone sloping down, the stark gray, on the top of this bear zone sloping down, this is strong bullishness. Strong bullishness. I'm very bull on the breakout. At least up until the election. This goes all the way through middle October, at least. But then leading into the election, there's a little bit of selling. So market is structured bullish, and I think that it's going to be disappointed today that the Fed is not going to exceed expectations. So I think we've accurately, effectively priced in any kind of rate cut we would get. So hit that tweet, give it some love. If you can see on the side of my screen, liquidity map show hedge pressure bull zone support. Now, again, in a case of an event, we kind of just don't really put a lot of bet on structure points other than pivots to trade off of. Like an example is I'm not looking at this to support hedge pressure off the event. Monthly hedge pressure and walls are my only two key points of interest today. So bull zone, monthly hedge. These are your two really strong pivots for the day. Bull zone and monthly hedge. These are the pivots that matter. 0 to 5 minutes, the market's going to move on the news. It's likely going to pop. There's a rate cut. If there's no rate cut, the market's going to hate that. It's going to hate hearing that. There's a rate cut, the market's probably going to hate hearing that too. It's the press conference that matters all. Because the press conference will hint at future rate cuts, and that's what we want to see. I am bullish this market. I am bullish this market. I am bullish long haul. I am in a bull bet right now. And I also have a bear bet. We're hedging it. Longer term out of the money puts. Shorter term out of the money calls. I am bullish. For Long haul. Let's see what's going on here. Oh shit, here we go. Internet froze for half a second there. It's like our data. Let me connect here really quick. Oh my god. Let's get Thinkorswim on here. There it goes. There it goes. $50 points. 50 points. Okay. This is the trade I'm in. That straddle trade, actually, it's moving quicker than that. 3,200, 111%, 120%. Let's go. I'm going to close that trade out. 478 is the strike. We're there right now. All right. Perfect. Okay, closed out. Was that my long trade? 478. Ooh. Ooh. $131% on that. The hedge is down. I closed everything out. Now I'm in my hedge. Market's going to hit expectation, 50 basis point. That's what I thought it was going to do. Now let it go. Dude, we jumped way off the screen here. I detailed it in the Zoom call today. You guys want to follow what I'm doing, you got to come to the Zoom call. That's the thing. Tell you how to come to the Zoom call. It's posted in there. We post it in the channels. We post it in everything. I had 478 calls on QQQ. They rent the money I sold. That's it. That's the expected move. Now I'm going to let it sell off. I told you guys I would close my leg. God, this is like so great. We're going to hit 478 and sell off. That's what I said. Nice. Let's see. Let's see if I'm right. Why do people watch anyone else trade? Double tap. Listen, guys. 568, 59. Like, literally. Here. Rare case. Double top and sell. That's it. That's all. That's it. That's all I can see today. Hit expectation. 50 basis point. That's it. That's it. I'm bullish this market. I close my trade. November meeting, futures are pricing in a 64% chance of 25 basis point cut then. That's it. I'm not buying this news. Press conference, everything. This was expected. Let's look at the median. I'll post stuff for you guys really quick. Aggressive rate cuts this year from the participants' assessment. That's actually pretty decent. Let's listen to that press conference. What we're looking for here on bullish long haul. Whoo. Drop the big cut. Problem is, Arsh, I'm holding the next week's expiration puts. Same thing. You made 60% on that pop. Made 131. And this, I'm still holding on to that. So these are my longer term hedged puts. These are my shorter term calls. Fed watch was on point, 66%. Yeah, so right here. So that was the trade I made this morning. At 468 calls on Q. As soon as I hit it, I sold. Sold. At the peak of that IV. Oh, boy. Whew. Oh, that was great. IV was at like 120% at that moment in time. Oh, I popped and dropped. The minute it hit, closed. Anyways. This is a hedge that was to hedge against that in case the market were to drop. Now I'm just holding my hedge for the week. I'm going to be longing this market as it goes up. The FOMC participants assessment. The median is somewhere about 4.5%. We're coming at 5% today on the news. From 5.5 is where we were. 5.25 was the general expectation, but Fed Watch was pricing last couple of days of 5. Now the assessment, the member votes are right at about 4.5 or less. This is aggressive for 2024, which means we are looking at least another half a basis point until the end of the year. Not a terrible thing. Okay. From here, it's not a long setup from here. You guys watch this. I set this trade up perfectly. Or 11%. I'm not going to touch features on this one. Hit that upper DD band, broke through. DD band's often a resistance. Question is, I don't know if I want to do anything on it. And watch. My puts, I can hold them. I literally spent $1,500 on these puts. That's it. They could expire worthless. And I net on that trade $2,400. Hedged. Bet that there's a breakout range. What happened? I tweeted about it. I call my tweet transparent trade. There we go. Arsh was in a similar trade. Similar trade, Arsh. Hammered to a trade from the bottom. Got in again at 10 a.m. 60% of those. Yeah. Tapped hedge pressure. Rallied up. Let's go. Oh, I love it. Okay. I like that. It was such a... Like, I detailed the entire setup. Holding longer term puts as a hedge, continue long in dips next few days. No loss potential at all. I can't lose on this trade anymore. At maximum, I made 2,500 bucks. I mean, at minimum, I made 2,000 bucks. Can't go any lower than that. The net of 4,000 gain minus 1,500 premium on the puts, 2,500 promised gain. Feedback, you structure your string a little bit different than yours. Easily hit your limit sell on the calls, waiting to hit your seller in the puts. You're in profit, even puts go to zero. Dude, feedback, same as me. I did the same trade. It's funny that you guys all did different trades than me, and it's weird because, like, I'm not here instructing you guys what to do. Y'all are learning from what we teach. All you guys did everything differently than I did. I'm so proud when I do my fucking homework. It works. Wasn't like I made a landslide, like, you know, 30K like I did that one day. But I mean, it's just when the structure is good, the structure is good. Hold on, let me eat my eggies. You can argue with that. I don't know, man. We hit expectations. The FOMC assessment came in at another half. It's not that aggressive. October, November, December, 3 months for 50 more basis points. Do I show my... My puts are at full value now, right here. Listen, guys. 468. Why did I pick 468? I mean, 478. Why? Tell me why. Tell me why. Why did I pick 478? We had a class on it a couple days ago. Right here. That's it. DD bands. Market isn't going to break DD band and keep going. There's only a 3% chance that that happens through all of events, including catalysts. So it could, but we don't bet that it happens, right? And the market needs to exceed expectations for that to happen, which it very well could. But when the market was betting on 50 basis points, there's no way we were going to exceed those expectations. So I closed my calls right on the pop. Margin requirements, but basically the DD band, which is based on margin requirements, yeah. So to detail my trade, spread and options once the pop was there, it was insane. Oh, dude, so insane. So how I structured this today was, as we were trading inside of here, right when we popped to about right there, I bought 461 puts. Actually, let me do it in Thinkorswim. A little bit more. I already have it set up. Let me show you what I did. That's the wrong one. I just love when I do my homework. It turns out pretty good. Bullish long haul. Of course I'm bullish long haul. Are you kidding me? Monthly maps do not lie. All right, 461. You guys remember from your course is what they call impact red line? Okay. If there's a sell-off, which I don't think there will be. So today we had a very tight breakout range. Very tight. I'm talking like super tight. Meaning that either side of this is going to be pretty drastic. Actually, I think it was more like down here. MHP was like right here. It was so close, and we're so close to monthly expiration, that a collapse of this would be devastating. Like, that would be bad. And upper DD band, as we knew that basis points were going to be at least 25, maybe 50, all I did was bet that we hit the DD band. That's it. I bought near-term expiring options. The minute we tapped it, I closed out. I had a hedge here. When we were up here, I bought the puts. When we were down here, I bought the calls. So I had the puts when they were cheap, the calls when they were cheap. The calls expire near term, 1 day out. I needed just 1 day to hit that. Class, why did I buy them? Why did I buy them 1 day out instead of buy them today? Tell me why. IV. There you go. Cliff nailed it. IV. Why pay such a ridiculous premium on the IV? The 30% for those. 120% for the 100 sorry, 80, 90% for those. Not even worth it. Puts. 5 days out. Just in case we didn't hit expectation, the market was disappointed. I feel like the market's still going to be disappointed, but the assessment proves that we're going to get more rate cuts through the year. That's actually pretty good. So I don't think these puts are going to expire at all. The money. So what I did was I spent about, I think it was like $4 grand. Maybe 3,500. I can't remember, something like that. 3,500 on these. Like 1,500 on those. And I legged into them when they were both cheap. Such that if we didn't break the range or we were trading inside of just here, that I was losing nothing. Like the puts and calls are relatively gaining each other. This being long enough, the theta of this was going to lose about 400 a day. Oops, theta. The theta was going to lose about 400 on these. I was going to hold these for just 1 day in case the market collapsed. If the market were to collapse, it would collapse big. This would gain at least 300 to 400% if it fell to offset the loss. Because monthly hedge pressure was so close, we know that's a devastating loss to the market if it does. I had a week for them to play out, so the theta is going to be small, the IV is going to be small, and I'd lose about 400 bucks worth of theta if the market went absolutely nowhere by the end of the event. And here's how fucking good I am at my calculations, because we've gone slightly up and it's only $545 down. I told you if we stayed in the range, I'd only be down about 400 bucks, and 545 is pretty close. That's how much I plan for my options trades. So it's got $1,000 worth of residual value. If this continues to rally and it never hits there, I lost 1,500 bucks on those puts, but I gained 4 grand on the calls. $2,500 minimum gain on the trade. Agree with that. It's like a straddle, but not really a straddle. It's very hybrid because I use calendar to assume the theta. Like I don't want to. I'm gonna lose. I'm expecting the market to go up on bull optimism. I'm only gonna lose $400 today on theta if it went absolutely nowhere. That's it. I would have closed. If we went absolutely nowhere, I would have closed those puts by the end of the day anyways. They're there to hedge me if we fall. If we rally and beat expectations, that'd be even better. It was impossible, I thought, to beat expectations. Fed's not gonna go more than 50. So when I hit my strike, I closed out the calls as they were up 130%. 130% of this is much more than, you know, 100% loss of that. As I assumed the IV would be close to 130, 150%, those options went up that high, which was great. Right when we hit the expected range, 478, I closed out. Price the airline hasn't moved, but the options premium had moved. Absolutely. When you got those, yeah. If you have a basic brokerage, a lot of guesswork on what your fill is going to be, going from 10 cents wide to $2 wide. Oh, yeah. Yeah. Stop. Always have limits, right? It's hard to guess what the price of your option will be. You can estimate it, but you don't know what the delta will be. You can assume if you're striking at the money, your delta will be 0.5, but you still won't know all the price of the option because you won't know the IV and the other pieces of it. You can estimate what your option would be. Really hard to hit a limit sell on the price of the option. But yeah, so I had 5 days here just in case it fell. And if it sells off, then I win both trades. The only way I would have lost this trade, literally, there was no way to lose this trade except for the following thing. Okay. I bought my puts at the top. I bought my calls at the bottom. If the market would have stayed in here and I would have held both of them over the term, I would have lost both. Had the market stayed in here for a day and gone nowhere, I would just closed out the puts at a $400 loss of theta and then bet on the bull market because we're going to get rate cuts. Easy as that. The range was tight enough for me to believe the breakout was pretty possible, and that's it. It wasn't a big, like, you know, it's structure that makes me happy, that I planned it out right. I could put a bigger bet on this, but I'm not going to risk, you know, 30, 50, 100 grand on Fed. I'll put $2,500 to $3,000, something like that. Moderate size trade. Did I already close the put side? No, I'm holding the put side. I'm holding it for the end of the day. I'm holding it. At most, it'll lose $1,000 from here. So just, and it's a week worth of puts too. So it's kind of like, or a week worth of pressure. So any day or two, we have expiration on Friday, which I made sure to buy it after expiration. If we do have any selling in expiration, then that's going to be problematic. So I'll have some puts just to hedge against any calls I do day trade on. So say like tomorrow, we're at a spot and I long the market. I do have some puts still there just in case. And again, we know red line is usually where we tap to. So any big sell-off day that we could possibly get, I'm ready to go on that. Our press conference in 6 minutes, you guys. You're ready for Papa Powell getting up here talking. So I'm going to start teaching options in this 20-day. I'm going to go through a really awesome options course webinar. So if you guys haven't done it, we're doing this thing. It's like 20 days for $20. That's it. You can learn everything I know. Literally, and everybody do this. It's a whole new thing we're doing. It's optional. We're using this money to raise capital so we can hire 2 more developers so we can put probabilities on the chart. Finally, after years of planning that, we're ready to go. No futures trades on this. No craziness. Now, the market moved and came back, which we learned in our catalyst class, means it was effectively priced in, 50 basis points priced in. Already, the market got it right. We understand the event is a non-event. Right? Priced in. Wall Street got it right. We told you that if Wall Street would get it right, it would be priced in. So, 50 basis points came in. Why are we continuing to move higher? So why? The news, the rate cut came in like we wanted. But why did we rally? Take a guess. What surprised the market? Anybody know? Something came in that was a surprise. Participants assessment came in. Any outlook for the future is the next thing. They're betting on future rate cuts this year. The market is trying to effectively price in 2 more rate cuts. Or 2 more, sorry, 50 more basis points. And that's why we're moving here. The next one. The market's always pricing in the future. Next meeting. You see how this works? Now you guys are starting to learn how to be master traders. Yeah. Next meeting. You guys are getting it. Hal goes, fuck your puts. Detailed it here. System assessment, appropriate monetary policy, midpoint of target range of target level for federal funds rate. These are votes by individual participants. Each participant voices their opinion on what they think is going to happen. The majority of them believe, as we are at 5 right now, 100% believe in another cut at the end of the year. That's so amazing. What was that? 100%, every single one of them. I was pretty adamant yesterday that no cut today. I didn't think we would get a cut. I thought it was too soon, but I did say it was possible. This morning, I changed, Patrick, this morning I made a whole new post and said that we would be getting a cut. I was watching the Fed Watch, and it just seemed evident in the participation of traders yesterday and today that it was likely we get cut. I think it's too early, but the Fed doesn't seem to think so. Mine was more along the lines of people are being overly optimistic, but Mostly because we're not at the 2% yet, but Jackson Hole Powell did say they're not going to wait for that. They don't necessarily have to wait for that. So most people feel in the longer run we'd be down at 3%, that that's appropriate monetary policy. We're betting on the biggest bull market we've ever seen. That's great. That's the start of it. I've been telling people for years. I said we'd be at 6,000 S&P by the end of the year. All right, so the press conference, go. Here's a trick, you guys. You don't want to listen to the press conference. Financial Juice got everything right up here. Financial Juice is what I love to do. I let them just detail it. Their algorithms will pull out the important text and just spit it up here. Powell's talking. I don't gotta listen to him talk, but we can if you want to. Strengthen labor market. Who talked about the labor market today? You did.
Has remained resilient, and investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of 2% over the next few years. In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year. The unemployment rate has moved up, but remains low at 4.2%.
I also was talking about that.
Nominal wage growth has eased over the
That
past
was
year.
part of the reason to be
jobs
cautious.
workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June.
I hate when this tries to like
notably
do
over the
that.
past 2 years, but remains above our longer run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2%.
Wish you could just hold like
over the
Alt or
12
Shift or
months ending in
something and
August.
like turn that
And that
Windows
excluding the
Arrow
volatile
stuff
food
off.
and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation, and appropriately so. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a half percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward
Inflation has
a more
eased
neutral
notably, but
stance.
remains above our goal.
We are not on any preset course. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing
S&P hits
restraint too
D-band
slowly
sells.
could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June. consistent
Nothing's
with
beating
the projections
expectations,
for
by the
lower
way, so
inflation
the
and
market's
higher
going to have a hard
unemployment,
time.
as well as the changed balance of risks. These projections, however, are not a committee plan or decision.
Markets have a hard
As the
time selling
economy
off because there's no
evolves,
bad news. The
monetary
market might have a
policy
hard
will
time
adjust
rallying
in
because we
order
hit
to best promote
expectations.
our maximum employment
My bet is still
and
up.
price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do.
Yo,
is
friends
in
over on
service
YouTube,
to
hit
our
that like button
contribution.
below the stream. Let's
We
get
at the
that
Fed
get
will
that
do
ratio
everything
up
we
to
can
half.
to achieve our maximum employment.
Don't forget to leave
and
comments in the
stability
stream
goals.
too. We love when you guys leave
Thank you.
comments.
I look forward to your questions.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking our questions. In July, you said you weren't necessarily thinking about a 50. You didn't want to be specific, but you said you were thinking about a 50. The inflation data last week came out a little firmer than expected. Retail was strong, third quarter GDP running 3%. So what changed and made the committee go 50, and how do you respond to the concerns that perhaps it shows the Fed is more concerned about the labor market? And I guess, should we expect more 50s in the months ahead? And based on what should we make that call? Thank you.
So, okay, a lot of questions in there.
Yeah.
Let me jump in. Since the last meeting, we have had a lot of data come in. We've had the two employment reports, July and August. We've also had two inflation
That
reports,
music
including
on.
one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige Book. And so we took all of those and we went into blackout and we thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision. So that's one question. What was the second and third?
How do we make the, sorry, thank you, sir. How do we figure out?
You guys see how
in the
that
months
DD
ahead,
band's that
is there
pivot?
another
You guys like the
25
DD,
or
that
50
green line
coming
is the pivot?
Based on what shall we make that call?
Nailed it.
Thank you.
Sure. So, a couple things. A good place to start is the SEP, but let me start with what I said, which was that we're going to be making decisions meeting by meeting based on the incoming data, the evolving outlook, the balance of risks. If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high.
Here's your
and unemployment
probabilities.
low, to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time. There's nothing in the SEP that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection. We know, as I mentioned.
Wait,
in my
Mike, you
remarks,
top ticked with
that
me and sold a credit
the
spread
actual
for
things
all
that
the
we do
money?
will depend on the way the economy evolves. We can go
You guys are
quicker
smart.
if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate.
We might cut the stream early.
That's what we were contemplating.
I'm not, I don't think I'll make any
And I
trades
would
from here, but I'm
point you to
definitely
the
not longing
S&P
from here.
As just an assessment of where, of what the committee is
Maybe I
thinking
got it
today,
right with
what
my
the
prediction
individual members,
when I
rather, of the
tweeted.
committee are thinking today, assuming that their particular forecasts are realized.
Did anybody trade today?
Hi, Chris Ruger,
What trades
Associated
what
Press.
trades did all you guys do
Um,
today? I
The
want to know what y'all
projections show
did.
that the Fed officials expect the Fed funds rate to still be above their estimate of long-run neutral by the end of next year. So does that suggest you see rates as restrictive for that entire period? Does that threaten the weakening of the job market that you said you'd like to avoid? Or does it suggest that maybe people see the short-run neutral as a little bit higher? Thank you.
I think the way I would really characterize it is this. I think people write down their estimate, individuals do. I think every single person on the committee, if you ask them what's your level of certainty around that, they would say there's a wide range where that could fall. So I think we don't know. There are model-based approaches and empirically based approaches that estimate what the neutral rate will be at any given time. But realistically, we know it by its works. So that leaves us in a place where we expect, in the base case, to be continuing to remove restriction, and we'll be looking at the way the economy reacts to that, and that'll be guiding us in our thinking about the question that we're asking at every meeting, which is our policy stance the appropriate one? We know, if you go back, we know that the policy stance we adopted in July of 2023 came at a time when unemployment was 3.5% and inflation was 4.2%. Today, unemployment is up to 4.2%, and inflation's down to a few tenths above 2. So we know that it is time to recalibrate our policy to something that is more appropriate given the progress on inflation and on employment moving to a more sustainable level. So that the balance of risks are now even. And this is the beginning of that process. I mentioned the direction of which is toward a sense of neutral, and we'll move as fast or as slow as we think is appropriate in real time. But what you have is our individual accumulation of individual estimates of what that will be in the base case.
Howard?
Howard Schneider with Reuters. How close was this in terms of the decision? You do have the first dissent by a governor since 2005, I think. Was the weight clearly in favor of a 50, or was this a very close decision?
I think we had a good discussion. If you go back, I talked about this at Jackson Hole, but I didn't address the question of the size of the cut and left it open.
You took a bear
I think we
zone
left it
top
open
to bull
going
zone,
into
bottom
the
scalp?
blackout. And so there was
Build a
lot of
weekly strangle?
discussion, back and forth, good diversity of division, excellent discussion today. I think there was also broad support for the decision.
My puts are right back
that
at
the committee
starting
voted on.
point.
So, I would add, though, look at the SEP. All 19 of the participants wrote down multiple cuts this year, all 19. That's a big change from June, right? 7 of them wrote down 3 or more, and 17 of the 19 wrote down 3 or more cuts, and 10 of the 19 wrote down 4 or more cuts. So, there is a dissent,
Right back.
and there's a range of views, but there's actually a lot of common ground as well.
Follow up to that, now that this is in the books, can you give us some guidance, as sort of follow up to Steve, on the pacing here? Would you expect this to be running every other meeting once we get into next year? For example?
We're going to take it meeting by meeting. As I mentioned, there's no sense that the committee feels it's in a rush to do this. We made a good, strong start to this, and that's really, frankly, a sign of our confidence. Confidence that inflation is coming down toward 2% on a sustainable basis. That gives us the ability. We can, make a good, strong start, but and I'm very pleased that we did. To me, the logic of this, both from an economic standpoint and also from a risk management standpoint, was clear. But I think we're going to go carefully, meeting by meeting, and make our decisions as we go.
Gina?
Hi, Chair Powell. Gina Smilek with the New York Times. Thanks for taking our questions. You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It continues increasing. And so I wonder if you can walk us through why you see the labor market stabilizing, sort of what's the mechanism there, and what do you see as the risks?
Jolts are coming down. That's
So,
why.
Again, the labor market is actually in solid condition. And our intention with our policy move today.
But
is
she's
to keep
asking
it.
him, why do you think
You
it's
can say that
solid
about the
condition?
whole
He's
economy.
avoiding that
The U.S.
question.
economy is in good shape. It's growing at a solid pace.
He didn't answer that question.
Inflation is coming down. The labor market is in a strong pace.
Not a
We wanna
strong
keep it
pace.
there.
He's lying, dude.
That's-
What a liar.
That's what we're doing.
It's a pace. It's a weak pace. It's not a strong pace. We talked about that in my post. It is growing slowly. It's not strong enough. They're trying to keep the market good into the election. That's what they're trying to do.
Nick Timmeros of the Wall Street
Markets are
Journal.
selling off
General,
at this
does
weak,
today's
moderate
action
pace we can lose
constitute a
traction. They just don't want to
catch-up
keep.
in
They want to give
action
some
given recent
optimism.
Substantial revisions to
That's all they
the
wanna do.
employment data, or is this larger than typical rate cut a function of the?
If I can ask
elevated
J-Pal something, what would it be?
of
That's a
the
great
policy
question.
rate, such that an accelerated cadence could be expected to continue?
What would I ask him?
Okay. Multiple questions in there, but so I would say.
Oh God, there's
we
so
don't
much.
think we're behind.
Like in general, or about their policy? Like if I could ask one secret question at the press conference, or like in general, like if I had a dinner with him, I could ask him something general.
It's a strong move. Sorry, your
And
other
he's
question was-
forced to
What happened in the employment data
answer the
between
question
this meeting
truthfully.
and the last meeting, or is this about
If it's the latter, and I can ask him one thing
the high nominal level of the funds rate
at the press
relative
conference,
to, what might be expected if
I would
the
ask
Fed
him
maintained
what
with
data
I think
has he
it's about-
used
we
to
commented
justify
this,
that he believes the labor
with
market
the
is
policy position
improving
that was put in place, as you know, implemented
strongly,
in
like he
July
just
of
said. I don't believe that that's
2023,
accurate.
Which was a time of high inflation and very low unemployment.
I proved the case in my Twitter post today that the labor market is stagnating and slightly growing. The jolts are coming down. The jobless claims are still flat. Unemployment's slightly going up. These things
That patience has
do
really
not
paid dividends.
do not
In the form of our
show
documents that
strength.
keep
They
moving
show
sustainably.
stagnation.
So I think that is what
Right.
enables us.
So I would say,
to
what data are
stay
you
strong.
using to make that judgment
I
call?
do not think that anyone should look at this and say, oh, this is the new pace. You know, you have to think about it in terms of the base case.
I think the jobs market is
What
slower than
happens
he's
will
leading on to
happen.
believe,
So
but
in
that's just
the
me.
base case, what you see is.
If I had to ask him something that he can't lie about,
The sense of this is we're recalibrating policy down over time to.
I'll be,
a
do
more
you
neutral
sometimes
level.
lower
We're
interest
moving
rates
at the pace
just to
that
put
we think
optimism
is
in the stock
appropriate given
market
developments in the economy in the
because
base
you
case.
believe that the stock market
Economic
falls, then
development
people will
rate
get laid
will
off and
go
make the
faster or
situation
slower.
worse?
But that's
i.e.,
what the base case
is the
says.
plunge protection team real? We have to say yes.
2019, when you did the mid-cycle
Problems that the
adjustment,
data's fake is what
balance
they
sheet
said. Yeah, that's the other problem.
with
Data's
the
not even
lower
real.
cut today,
Sometimes.
should there be any signal inferred about?
Do you guys step in and rescue the stock market as a means to prevent layoffs? That's what I'd ask him, because that's really what they do.
Current, situation, reserves have
That's what they're doing
really remained
today.
stable. They haven't
It's
come down
stagnation. They
significantly.
put some
They're still
optimism to the
funded
market,
and expected to remain so.
especially leading into like the
As you
volatility of the
noted,
election.
The
Right?
shrinkage in our balance sheet has really come out of the overnight RRP. So I think what that tells you is we're not thinking about stopping runoff because of this at all. We know that these two things can happen side by side. In a sense, they're both a form of normalization. And so for a time, you can have the balance sheet shrinking, but also be cutting rates.
Ask him. Somebody said they'll ask him why he thinks central planning works.
Thank you. Colby Smith with the Financial Times. Just following up on Gina's question on rising unemployment, is it your view that this is just a function of a normalizing labor market amid improved supply, or is there anything to suggest that?
Do you
something
hear all these
concerning
people asking the same
capacity
question I'd
in
ask
place
him?
here, given that
They're
other
literally
measures
calling
of
bullshit
labor
on his
demand have
assessment of labor
faltered too?
market.
And
You hear
I
them,
guess,
right?
a
The second
maybe a better
person.
follow-up to Gina is, why should we not expect a further deterioration in labor market conditions?
You hear these people calling bullshit on the same thing I call bullshit on?
I think what we're seeing is clearly labor market conditions have cooled off by any measure, as I talked about in Jackson Hole. And, but they're still at a level. The level of those conditions is actually pretty close to what I would call maximum employment. You know, so you're close to mandate. Maybe
That's true.
on that.
I said that in my tweet today.
So what's-
It's around where it should be, but it's
Clearly,
not growing.
job
It's just
creation has
normal.
moved down over the last few
Normal.
months, and this bears watching. meant by many other measures, the labor market has returned to or below 2019 levels, which was a very good.
That's what I said as well.
This is more sort of 2018, 17.
Let's read my post.
So the labor market bears close watching, and we'll be giving it that. But ultimately, we think, we believe, with an appropriate recalibration of our policy, that we can continue to see the economy growing, and that will support the labor market.
It's a fancy word of saying if we cut rates, it'll continue to put hope in the economy and grow the labor market, which is really what they're doing, propping up the stock market to boost the labor market.
That should also support the labor market over time.
They're feeding into the bullish optimism.
It bears watching, and we're watching.
They just don't want the market to be bearish because that is really the driving catalyst right now.
If
Okay.
that were to happen, would
So-
the committee already be too late in terms of avoiding a recession?
Available jobs in decline, which means jobs are getting filled.
The plan, of course, has been to begin to recalibrate. As you know, we're not seeing rising.
But they're being filled faster than they're being created, or jobs being eliminated, which means layoffs. So you can disprove the layoff thing by looking at the continuing initial jobless claims. Initial jobless claims aren't spiking outside of the expected normal range. 200, 300K week is pretty normal.
When you begin to see the layoffs.
As he said, these are 2018, 2019 levels. Exactly right. We're not laying anybody off right now. And continuing jobless claims are not coming down, which means we're not in a hiring spree either. We're just kind of at a normal pace, a slow growth, normal pace. That's it. Normal. Not accelerating, not growing, decent and reflective of the bull market we had before, and that's really his data point, is it matches 2019 levels, like you said. Exactly right. Telling people you believe in a strong labor market. It's normal. We are not in a hiring spree.
Would you be moving to a more preemptive?
They don't want there to be a hiring spree either,
rather than, as you did with inflation, waiting until
because if the supply of jobs outpace the demand, then inflation goes back up. So they're really trying to create a moderate circumstance where the market doesn't crash. And what really scared them was the bearishness the last couple of months, especially leading into the election, the volatility that was planned, or sorry, that was positioned for. I think they're just trying to put some optimism into the market such that the labor market doesn't deteriorate from here, but it's certainly not in a growth spurt. You would see those continuing jobless claims coming down, the unemployment rate going down, and jolts less of a decline and more of like starting to like slope up and flatten, because you're going to have companies creating jobs while people are filling them in, so it would be flat. Right? So there is no like company that's like, okay, we're expanding right now, let's go ahead and create a bunch of jobs. Like in general, no one's doing that.
What I would say is,
So we're not at the expansion phase of the economy yet. We're at the bottoming phase. So this is the start of the bullishness, but it's the start. It's not as superly optimistic.
I think you can
I
take
think it is. How accurate is the data in general? The data they look at, dude, these numbers all the time are like published and then revised.
price stability without the kind of painful
All the time, man.
increase in unemployment that has come sometimes with disinflation. That's what we're trying to do. And I think you can take today's action as a sign of our strong commitment to achieve that goal.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You're describing this view that you don't think you're behind when it comes to the job market. Can you walk us through the specific data points that you found to be most helpful in the discussions at this meeting? You've mentioned a couple, but would you be able to walk us through what that dashboard told you as far as what you know about the job market now?
Sure.
Don't forget they just revised jobs data down by like 1 million.
Single most important one, probably. You're at 4.2%. That's, I know that's higher than.
I like how the market is trying to find some selling pressure, but
Threes last year, but if you look back over
volatility is kind of shit the bed today. VIX is below 25 monthly hedge pressure, so volatility not building right now, but I don't know if the markets can pick up momentum today.
It's we're right adjusted for demographics.
Fed policy is an exact science based on manipulated data
Pretty high levels. That's a good thing.
and opinions and political opinions as well.
What would be their wage increases rather are still just a bit above where they would be over the very longer term to be consistent with 2% inflation, but they're very much coming down to what that sustainable level is, so we feel good about that. Vacancies over,
Okay, so no Zoom call today, you guys. This is basically it. We can cover some of the Fed stuff. But
number reached 2 to
with the
1.
frenzy it is today, I like to let like the day's data.
As measured, it's now below around. It's around. But that's still a very good number, I would say. You know, quits have come back down to normal levels. I mean, that could go on and on. There are many employment indicators.
Side note,
they say this is still a
distance
solid
between
number.
here and here is one
The
risk
question isn't
interval.
the level. The question is that
Is
there's
FYI.
been change particularly over the last
But
few
with,
months.
with an event day,
And, you know, so what we see
non-event, no
is
catalyst,
the-
nothing. There's only
is the
nothing to
risks,
use
the
today.
upside
So,
risks to inflation have really come
I mean, holding my
down.
puts or closing in the day,
Downside
I
risks to
might close in the
employment
day.
have
It
increased.
depends.
And because we have been patient and held our fire on cutting.
The market sells in the day, I'll probably hold them and use them as hedges for next week and the week after.
To manage the risks to both of our goals.
Essentially, the puts will just be free money to reinvest in the dips.
November
Does
will
that make
help
sense, Ben?
inform the scale of the cut at the next meeting.
The market dips really hard, and then that put
The usual. Don't look for anything else.
appreciation is just free money to buy the dip with.
We'll see another
Puts expire worthless.
jobs report. I think we get we might,
Like
actually
if we
get
rally
jobs
higher,
report
I
on
might
the day of the
still
meeting, I think.
hang on to them. I only have $1,000 of risk on the table.
So
So they're good for like any particular day. However, they're going to become worthless like
it's always a question of
at least by
incoming
next
data
week.
and ask what
So
the
I might only
implications
consider holding them for maybe
outlook and the
through
benefits.
Friday.
And then
Like if Friday expiration dips
process
pretty
is
hard,
the right thing to do, is
like Thursday and Friday dip, I will definitely close them before Friday.
foster the
I don't want to hold them in the
achievement
theta
of
burn
goals
day,
over time. So that's what
last
it
2 days
is.
of expiration, because like we're so far out of the money. They'll basically become worthless. Hold on 1 second.
Hi, Chair Powell. Neil Irwin with Axios. We've only been running a little above 100,000 jobs a month on payrolls the last 3 months. Do you view that level of job creation as worrying or alarming, or would you be content if we were to kind of stick at that level? And relatedly, you know, one of the welcome trends of the last couple of years has been labor market steam coming out through job openings falling rather than job losses. Do you think that trend has further to run, or do you see risk that further labor market cooling will have to come through job losses?
So on the job creation, it depends on the inflows, right? So if you're having millions of people come into the labor force, then and you're creating 100,000 jobs, you're going to see unemployment go up. So it really depends on what's the trend underlying the volatility of people coming into the country. We understand there's been quite an influx across the borders, and that has actually been one of the things that's allowed unemployment rate to rise. And the other thing is just the slower hiring rate, which is something we also watch carefully. So it does depend on what's happening on the supply side. And on the beverage curve question, yes. So we all felt on the committee, not all, but I think everyone on the committee felt that job openings were so elevated that they could fall a long way before you hit the part of the curve where job openings turned into higher unemployment, job loss. And yes, I mean, I think we are, it's hard to know that you can't know these things with great precision, but certainly it appears that we're very close to that point, if not at it, so that further declines in job openings will translate more directly into unemployment. But it's been a great ride down. I mean, we've seen a lot of tightness come out of the labor market in that form without it resulting in lower employment.
Thanks, Chair Powell. Edward Lawrence, Fox Business. So we've heard some speculation that you may be going with the federal funds rate to 3.5, maybe under 4%. And there's basically an entire generation that has experienced zero or near zero federal funds rate. Now, some think we're heading in that direction again. What's the likelihood that cheap money is now the norm?
So this is a question, and you mean after we get through all of this? It's just a great question that we can only speculate about. Intuitively, many people anyway would say we're probably not going back to that era where there were trillions of dollars of sovereign bonds trading at negative rates, long-term bonds trading at negative rates. And it looked like the neutral rate might even be negative. So people were issuing debt at negative rates. It seems that's so far.
It'd be great if the market did sell off too, and I went on both the calls and the puts.
That we're not going back to that.
88% chance we close inside of the band.
But it feels
8% chance
to me, and
that we close outside of the band on the downside, 4% the upside. And of the one that hit the top band,
how high is it? I just don't think we know.
what was it?
Again, we only know it by its works.
a quarter of them reverse to the other band.
criticism that will likely come
So of the
from a deeper
12%,
right now before the election has some political motivations.
Yeah, so
let me double check the stat. This is our stat from the other day.
At the Fed, and it's always the same. We're always going.
You guys remember how much it was? It
this meeting in
was
particular, and asking what's the right thing to do for the people we serve, and we do that.
27% reversed. If you touched one band, 1 out of 4 reversed to the other band.
That's always what it is. It's never about anything else. Nothing else is discussed, and I would also point out that
So a quarter of 12 is 3% chance you reverse.
with a lag.
So a quarter of 12 is 3.
This is
Boom,
what
boom,
we do.
boom.
Our job is to support the economy on behalf of the American people. And if we get it right, this will benefit the American people significantly. So this really concentrates the mind. And, it's something we all take very, very
Hold on,
seriously.
let's turn the camera on here.
I think if you start doing that, I don't know where you stop. And so we just
Wait,
don't
hold
do
on.
that.
Got iDoc over here. She's on her way to TwitchCon. Can you see?
Thank you.
Your head is
Jill
in the
Lancaster
way.
with CBS News. My first question is,
She's here
just
to.
very simply, what
She's
message
here to-
are you trying to
Oh.
send to American consumers, the American people, with
Trader-
this
trader porn.
unusually
This
large
doesn't look
rate cut?
important at all, actually.
I would just
Are
say
these
that,
lines,
the
red,
U.S.
green
economy is in a
Oh,
good
that's
place.
important.
And
The old people
our-
talking is
our
not important.
decision today is designed to keep it there. More specifically, the economy is growing
Yeah.
at a solid
She's-
pace. Inflation
She's on her way to
is coming down,
TwitchCon to go meet a bunch of
closer to our
streamers.
2% objective over time.
So what's in it for me?
And the labor market is
What's in it
still
for you?
solid shape.
Yeah, what's in it
So
for me?
In this?
Our intention
Yeah.
is
Nothing.
really to maintain
Nothing
the
at all.
strength that we currently see in the U.S. economy. And we'll do that by returning rates
We
from their
watched
high level,
this
which
guy
has really
talk.
been, the
Jay
purpose of
Powell,
which has
Big
been to get
Papa.
inflation under control. We're
He
gonna move
says
those
stuff
down over time to a more
that we already knew
normal
he was going to say.
level,
Okay,
over time.
so that's a good thing.
And the stock market
Follow-up
likes to
that,
bet on what he
listening to
says.
you talk about inflation moving meaningfully down to
So it
2%.
is like a fun game or
Is the
something?
Federal Reserve effectively
Yeah. No, literally like watching Powell, what he does. Oh, it's a game. It's a game everybody plays.
No.
Trying to bet
Um,
like, what this
we're
guy's
not.
going to say.
So, inflation, what we say is we want
They like to print money and prop
the
up the
goal is to
stock
have
market
inflation
and then
move down to
justify with all
2%
this data, but
on a
really they're
sustainable
just,
basis.
we want the stock
And,
market to rally.
We're not really, we're close.
Fugazi,
but we're not
fugazi,
really at
fugazi,
2%.
fugazi.
And I think we're going to want to see
Oh,
it
made up.
be, around 2% and close to
All
2%
right, say bye.
for some time.
She's off to TwitchCon.
gotta go.
We're certainly
Bye,
not
guys.
we're not saying mission accomplished or anything like that. But I have to say, though, we're encouraged by the progress that we have made.
Hi, Katerina Saraiva with Bloomberg News. I just would love to know kind of how the committee is thinking about the persistence we've seen in housing inflation. Do you think you can return to 2% with housing inflation where it is? Yeah.
So, housing inflation is the one piece that is kind of dragging a bit, if I can say. We know that market rents are doing what we would want them to do, which is to be moving up at relatively low levels, but they're not rolling over. The leases that are rolling over are not coming down as much, and OER is coming in high. So, it's been slower than we expected. I think we now understand that it's going to take some time for those lower market rents to get into this, but the direction of travel is clear, and as long as market rents remain, relatively low inflation over time, that will show up. Just the time it's taking now, several years rather than just 1 or 2 cycles of annual lease renewals. So I think we understand that now, but I don't think the outcome is in doubt. Again, as long as market rents remain under control, the outcome is not in doubt. So I would say it's the rest of the portfolio, or of the elements that go into core PCE inflation have behaved pretty well. They all have some volatility. We will get down to 2% inflation, I believe, and I believe that ultimately we'll get what we need to get out of the housing services piece too.
Some of your colleagues have expressed concern that with starting to cut rates, you could reignite demand in housing and see prices go up even more. What's the likelihood of that, and how would you react to that?
So the housing market, it's hard to game that out. The housing market is in part frozen because of lock-in with low rates. People don't want to sell their home. So, because they have a very low mortgage, it'd be quite expensive to refinance. As rates come down, people will start to move more, and that's probably beginning to happen already. But remember, when that happens,
He's out the TwitchCon to talk about Marketplace.
So it's not
Our Marketplace biz.
obvious how much additional demand that would make. I mean, the real issue with housing is that we have had and are on track to continue to have not enough housing. And so it's going to be challenging. It's hard to find, to zone lots that are in places where people want to live. It's all of the aspects of housing are more and more difficult. And where are we going to get the supply? And this is not something that the Fed can really fix. But I think as we normalize rates, you'll see the housing market normalize. And I mean, ultimately, by getting inflation broadly down and getting those rates normalized and getting the housing cycle normalized, that's the best thing we can do for householders. And then the supply question will have to be dealt with by the market and also by government.
Victoria.
Hi, Victoria Guido with Politico. Just following up on some of the labor market talk earlier, monetary policy moves rates with long and variable lags. And I'm wondering how much you see being able to keep the unemployment rate from raising too much comes from the fact that you're starting to act now, and that's going to give people more room to run versus just the labor market is strong. And then also, if I could, following up on Nick's question, do you see today's 50 basis point move as partially a response to the fact that you didn't cut in July, and that sort of gets you to the same place?
So you're right about lags, but I would just point to the overall economy. You have an economy that is growing at a solid pace. If you look at forecasters or talk to companies, they'll say that they think 2025 should be a good year too. So there's no sense that the U.S. economy is basically fine. If you talk to market participants, I mean, business people who are actually out there doing business. So I think our move is timely. I do, and as I said, you can see our 50 basis point move as a commitment to make sure that we don't fall behind. So you're really asking about your second question. You're asking about July, and I guess if you ask, if we'd gotten the July report before the meeting, would we have cut? We might well have. We didn't make that decision, but we might well have. I think that's not, that doesn't really answer the question that we ask ourselves, which is let's look, at this meeting, we're looking back to the July employment report, the August employment report, the two CPI reports, one of which came, of course, during blackout, and all of the other things that I mentioned. We're looking at all of those things, and we're asking ourselves, what's the policy stance we need to move to? It's clear that we clearly, literally, everyone on the committee agreed that it's time to move. It's just how fast do you go, and what do you think about the path forward? So this decision we made today had broad support on the committee, and I've discussed the path ahead.
Elizabeth.
Thank you, Chair Powell. Elizabeth Schulze with ABC News. Mortgage rates have already been dropping in anticipation of this announcement. How much more should borrowers expect those rates to drop over the next year?
Very hard for me to say. That's from our standpoint. I can't really speak to mortgage rates. I will say, that'll depend on how the economy evolves. Our intention, though, is we think that our policy was appropriately restrictive. We think that it's time to begin the process of recalibrating it to a level that's more neutral rather than restrictive. We expect that process to take some time. As you can see in the projections that we released today. And if things work out according to that forecast, other rates in the economy will come down as well. However, the rate at which those things happen will really depend on how the economy performs. We can't look a year ahead and know what the economy is going to be doing.
What's your message to households who are frustrated that home prices have still stayed so high as rates have been high? What do you say to those households? Well,
what I can say to the public is that we had a burst of inflation. Many other countries around the world had a similar burst of inflation, and when that happens, part of the answer is that we raise interest rates in order to cool the economy off, in order to reduce inflationary pressures. It's not something that people experience as pleasant, but at the end, what you get is low inflation restored, price stability restored. And a good definition of price stability is that people in their daily decisions, they're not thinking about inflation anymore. That's where everyone wants to be, is back to what's inflation. You know, we just keep it low, keep it stable. We're restoring that. So what we're going through now really, it restores, it will benefit people over a long period of time. Price stability benefits everybody over a long period of time just by virtue of the fact that they don't have to deal with inflation. So that's what's been going on, and I think we've made real progress. We don't tell people how to think about the economy, of course, and of course people are experiencing high prices as opposed to high inflation, and we understand that's painful.
Greg.
Hi, Chair Powell. Greg Robb from MarketWatch.com. I was wondering if you could go through, you said just at the beginning that coming into the blackout, there was like an open thought of 25 or 50. You know, the Fed could move either 25 or 50. I would sort of argue that when we had those two last speeches by Governor Waller and New York Fed President John Williams, that they were sort of saying that maybe a gradual approach was going to win the day. I mean, I sort of want to ask a 7-part question about this, but I mean, could you talk, would you have cut rates by 50 basis points if the market had been pricing in like low odds of a 50-point move like they were last Wednesday? You know, after the CPI number came out, it was a really small probability of a 50-point cut. Does that play in your consideration at all? Just talk a little bit about that. Thank you.
We're always going to try to do what we think is the right thing for the economy at that time. That's what we'll do. And that's what we did today.
Simon.
Thank you, Chair Powell. Simon Rabinovich with The Economist. You've mentioned how closely you're watching the labor market, but you also noted that payroll numbers have been a little bit less reliable lately because of the big downward revisions. Does that put your focus overwhelmingly?
I'm back. Sorry. I was helping her carry her bags.
Basically being the peak in the cycle, would going above that be the kind of thing that would trigger another 50 basis point cut?
So we will continue to look at that broad array of labor market data, including the payroll numbers. We're not discarding those. I mean, we'll certainly look at those, but we will mentally tend to adjust them based on the QCEW adjustment, which you referred to. There isn't a bright line. It will be, the unemployment rate's very important, of course, but there isn't a single statistic or a single bright line over which that might move that would dictate one thing or another. We'll look at each meeting, we'll look at all the data on inflation, economic activity, and the labor market, and we'll make decisions about is our policy stance where it needs to be to foster over the medium term our mandate goals. Yeah, so I can't say we have a bright line in mind.
Matt Egan.
Thanks, Chair Powell. Matt Egan from CNN. I know that you discussed earlier how the Fed does whatever the right thing is and nothing else factors in. But in general, can you talk about whether or not you believe a sitting U.S. president should have a say in Fed decisions on interest rates? Because that's something that former President Trump, who obviously appointed you, has previously suggested. And I know the Fed is designed to be independent, but why? Can you tell the public why you view that so important?
Sure. So countries that are democracies around the world, countries that are sort of like the United States, all have what are called independent central banks. And the reason is that people have found over time that insulating the central bank from direct control by political authorities avoids making monetary policy in a way that favors maybe people who are in office as opposed to people who are not in office. So that's the idea, is that, and I think the data are clear that countries that have independent central banks, they get lower inflation. And so we do our work to serve all Americans. We're not serving any politician, any political figure, any cause, any issue, nothing. It's just maximum employment and price stability on behalf of all Americans. And that's how the other central banks are set up too. It's a good institutional arrangement, which has been good for the public. And I hope and strongly believe that it will, continue.
Kyle.
Kyle Campbell for American Banker. Thanks for taking the questions, Chair Powell. A couple regulatory developments in the past week that I want to ask you about. First, last week, Vice Chair for Supervision, Michael Barr, outlined his views for the changes to the Basel III Endgame. I'm wondering if you are in alignment with him on what those changes should be, if those have support on the board in a broad way that you're looking for, and if you think the other agencies are also fully on board with that approach. And then yesterday, other banking regulators.
You know what? Hold the second question.
Okay, sure.
Let me we'll give you the second question. So, the answer to your question is that yes, those changes were negotiated between the agencies with my support and with my involvement, with the idea that we were going to repropose the changes that Vice Chair Barr talked about, and then take comment on them. So yes, that is, that's happening with my support.
Market's just kind of sitting there inside the 88% zone. Nothing great.
I understand. We're putting them out for comment. We're going to take comment. And
There's more than just carrying luggage.
We don't have a calendar date.
A little bit more.
And as for the other agencies, the idea is that we're all moving together. We're not moving separately.
You'll be gone until Sunday?
That I don't know exactly where that is, but the idea is that we will move as a group.